We'll start. So the first thing is, before anything else, I wanted to thank all of you. It's very important because on a Saturday, taking the time away from busy schedule and coming here, I am thankful to you. Secondly, before even we start the presentation, Montreal Exchange. So Santa is here, and I have some other representatives also here.
Mark as well.
They have been our supporters from 2005. First time, we got a call from Montreal Exchange. They said, we are calling. We want to talk to you. We want to talk to Avin. And I said, well, I don't do third-party product. I don't do mutual fund. I don't do anything else. So no, we are calling from Montreal Exchange, and you are sending the maximum option volumes to Montreal Exchange. That's why we want to talk to you. And the reason is, we have the same objective. We want you to educate the public. We want you to educate the investment advisors, portfolio managers working with us. So they have been supporters all through. And then in 2013, we addressed again as part of the expert team, 3 people. Then 2018 again. Then they gave us the top award of the country as best active manager in exchange trade derivative. And right now also today's presentation is also sponsored by them. And thank you Santa.
Thank you.
So this is a great team. And the main thing is, it is the common objective. Common objective is to have more liquidity in the Canadian marketplace, and that is through education. Educating the general public, educating the investment advisors, portfolio managers, so that they get involved. So for Montreal Exchange, definitely a big thanks. Then my family, my clients, and also CIBC, which has given us a very good platform. So that is, I wanted to take it out of the system before we start the presentation. So thanks everyone, and now we can start.
Yes.
Yeah, sorry, that's okay. Thank you. So this is the presentation today: selling covered calls, covered call writing, and other defensive strategies. And today we are focusing. Yesterday we focused on US ETF, right? Last year we had again 2 presentations. We focused on DIA, Dow Jones, and we focused on Apple. Fortunately, both did well. Yesterday was also okay. XLK, yesterday's presentation did well. This one has not done that well, unfortunately. But there is no problem there because it's stocks go up and down all the time. But if you have a strategy to deal with that, you are always in very good shape. So that is what we are going to talk about. So selling covered call writing, other defensive strategies. This is the agenda for today. Some concepts from real estate investing, call options, what, why, how. We'll define that. We'll talk about the issues involved, awareness, liquidity issues. We'll talk about uses in year and tax balancing, very, very important. Very few people understand that. These are one of the best tools to balance the taxes at the end of the year. We'll talk about that. And then alternate other option strategies, including puts and callers. So now, the most important thing is, in the year 2000, I joined Merrill Lynch because Merrill Lynch was the only company in Canada which understood options. I had selection from everywhere. I had all the industry qualifications. So CIBC, Royal Bank, everyone selected me. But nobody wanted to do options because somehow, they had the impression that options are too risky. And that is very far from truth. Options are very good tools. They can be used to commit harakiri, or they can be used to protect your portfolio. So we are on the other side. We are protecting the portfolio using options. So in 2000, now I was a teacher. I was not a salesperson at all. So Merrill Lynch, when I talked to them, they said, well, we understand options very well. We'll give you full opportunity, no target for you. You go ahead and do whatever you want to do. So what I did, on day 1, I started designing programs, the teaching programs, something on wills and estate planning, something on financial plans, something on taxation, something on different packages. And then I designed this covered call writing. The defensive option strategies and their compliance, we have to get approval for every single seminar that we present from the compliance. went to compliance and I used a term there, rent on stocks, right? And they came back, they said, what is rent on stock? You're talking about dividend. I said, no, I'm not talking about dividend, I'm talking about something over and above dividend, different source of income. I said, very grudgingly, they said, okay, we understand that, so what we'll do is, we'll allow you to present, but you put a disclaimer saying that this is Avin Mehra's view. I said, by all means, So I did that. In that presentation for last 23 years, there are few changes, but those changes are based mostly on the audience request or audience, their questioning. Every time we present it, we learn something new, right? That's why thanks to you. So some concept from real estate investing. So this is the situation. Why real estate? Because stock market people understand, sometimes they don't understand very well. Options sometimes they don't understand very well. But real estate practically everyone understands, right? So that's why when I designed, I used the terminology of real estate. So how many people own real estate here? Many. Now, how many people, when I talk about real estate, how many people have investment property? That means, investment property. Now, the thing is, if it is principal residence, there is no issue at all because you have to live somewhere. You buy the property for $1 million, it goes down to 900,000. Who cares? You have to have a place to live, right? Because eventually it will go up. In the meantime, you are not worried because you have to have a place to live. When it is investment property, you are worried because you bought something for $1 million, goes down to 900 or 950 or whatever, you start worrying because unless you have cash, plenty of cash, you are probably taking a mortgage, right? And mortgage cost will be high. And that is the situation right now in the marketplace. So that is real estate. We'll give that example. Example is simply this. You buy a property anywhere, you can say Toronto, you can say GTA, you can say Montreal, you can any other place. Montreal is slightly better at this stage, Toronto is not. So you buy the property for $1 million. Now what happens is, why you buy? The real estate agent comes to you and he says, this property in 2022, last year, February, it was selling for 1.2 million, right? And then the market crashed. Why? Real estate works opposite to the interest rate. When interest rate go up, real estate market crashes. I have seen that firsthand. I have firsthand experience from London, England, 1981-82. So the thing is, real estate, he is pestering you. The real estate agent says, this property was 1.2 million, now it is under foreclosure and you can buy it for 1 million. And you are saying, oh my goodness. The thing is, there is so much depression in the real estate market, I do not know where it is going to stop. It can go down to 900, go anywhere at all, right? So he is still pestering you and then you say, he or she, so then you say, well, if you are that confident, he says, they are again, when the interest rate starts stabilizing and start going down, again go back to 1.2 million. If you are that confident, why don't you buy it? And he says, I don't have money, I am overextended, I have 5 properties, I have lost money, I do not know what to do. So, however, I am so confident about this particular property, do me a favor, let us have a deal. Deal is this, you buy the property for 1 million, you have money, you buy the property and simultaneously you sell me the right of first refusal to buy the property from you at higher price 1.1 million in the next 1 year, right? If you agree to that, they pay you 100,000 for this right today, for the right of first refusal. That means even if the property goes up to 1.3, 1.4, you are stuck at 1.1. You have to sell it for 1.1. That is the right of first refusal. So this person can opposite party, but the contract is only for 1 year. Keep that in mind. And meter is running against the counterparty, right? Against that real estate agent. So they pay you 100,000. Now there are only 3 possibilities. Any fourth? 3 possibilities are property market. This property can actually go up. It does nothing for a year or during that period, contract period, or it goes down, right? Now if it goes up, you make money because your net cost was 900,000. You spent 1 million, you took out 100,000 from this counterparty. So your cost is 900,000 and you are forced to sell at 1.1 million even if it goes beyond that. So you are making 200,000 on 900,000. So these numbers are just round figures. So not necessarily that you have 22%, you can have 10%, 15%, anything. But this is just to illustrate. Now if the property does nothing, that means goes up, down, sideways at the end of 1 year, because it is 1 year contract, it is below 1.1 million, right? You keep that 100,000 free and clear. That is your money, right? So your cost is permanently reduced to 1 million minus 100,000, 900,000. With me? Now, sorry, today I am not taking questions simply because we have 45 minutes, right? But any questions you have, come to the booth, we will be able to answer any questions relating to options, right? So normally our session is for about 1 hour 15 minutes and then we stay back for one hour, whatever is needed. But today that is not the situation, so I am not taking questions. Now, so second situation, you keep 100,000 free and clear, your cost is permanently reduced to 900,000. Now you are free of contract, play again, play the next one, same real estate agent or any other counterparty, right? And sell the new contract in the context of the market. If the market is at 900,000, do it at 1 million or do it at 900, right? The third possibility, which is the worrisome thing, the property actually goes down because you are thinking, oh, this property is already, it has gone down, it can go down further, and actually it goes down. In that case, what you do is, whether it happens in 2 months, 3 months, 6 months, you go back to the counterparty, this real estate agent, and you say, why don't you free me up? The thing is, this property is not going to go up to 1.1 million, no way. So what I will do is, I will give you 20,000 today, right? Free me up of the contract, right? If you wait for 1 year, you get zero. Okay, your 100,000 is gone because time is running against you. If he agrees to that, you start making money in the option market, in this market, in the rights market, right of first refusal, rights market. So essentially your cost is permanently reduced because you made $80,000 in the option market or right market. Your cost is reduced from 1 million minus 80,000, 920,000. So this is just to illustrate, essentially right to buy is a choice. So the real estate agent counterparty had a right to buy for you could not sell it to anybody else, or he had a choice, or he had a call option. He could call for the property. That is what call option is all about. He could call for the property. So he was buyer of the call, right? That call, and you were seller. Now, for your counterparty has a right to buy or right to call. You have obligation to sell. You cannot sell it to anybody else during that 1 year period because he has given you money for that, right? He has bought that right. You cannot sell it to anybody else. The second example in real estate again because it is simple to understand real estate. Second is you buy the property for $1 million, right? And then immediately the real estate agent says, I have done all the due diligence, I have very good tenants for you, professional people, doctors, engineers, whatever, and accountants, and they are prepared to pay you $4,000 a month, right? And with the lease will also have escalation clause. So next year it can go up to 4,300 or 4,400, whatever is agreed to. That is, if you agree to that, if you sign that lease, right, in that case, it starts generating cash flow from day one. So cash flow generation means peace of mind, which is sleep at night factor. That means you are not worried to sell the property. Even if you bought for 1 million, goes down to 900,000, goes down to 950, anything, till you are generating cash flow out of the property, you are not worried. That is your sleep at night factor, right? So you are not in a hurry to sell. You can sell when you choose it at the right price. Meantime, your property is generating income because every month you are getting 4,000. So if you understand this, that's all there is to call options, nothing else. Now I'll pass it to Ankit.
Sure.
To go to the do the segue to the stock market.
Yes. Hello?
Oh, by the way, Ankit is my son.
Yep.
And he's a CFA, he's a BBA, CFA, last leg of MBA, and bright guy. So
My qualifications dwarf his qualifications, by the way. He's a lawyer by, his master's was in law and mathematics, and now he's a banker. So he has a lot more qualifications than I do, but I'm learning from him every day, and I've been around 11 years full-time at CIBC. And I love what I do. It's more of a lifestyle. I don't treat this as a job. But just segueing into call options, exactly the way that we had real estate. It's the right to buy the property. The realtor had the right to buy the property at $1 million. Same thing we do with stocks. When we're buying a stock, we're selling the right to someone else to take that stock away from us in a given period of time. For example, Canadian National Railway, we're keeping today's example Canadian because we're with the Montreal Exchange and we want option volumes in Canada to increase as you guys are trading more Canadian options because it helps everyone when it comes to liquidity and to boost spreads. But CNR, it's trading at a range of between 144.71 and 175.39 per share. That's the 52-week trading range. And we set a target in our system saying that we want to buy the stock, but we're not going to pay anything more than $150 per share. And we have the stock target for all our stocks, all our ETFs, all our indices. And once they reach those targets, that's the only time where we decide to take an entry. The reason that we chose CNR is the stock was going ex-dividend. That means any investor who owns CNR shares before that ex-dividend date, they would be eligible to earn the quarterly dividend. So in positioning for that, September, I believe it was the September 7th September dividend.
Was ex-dividend date.
Yep.
So we bought one day before to collect 79-cent dividend as well in a day.
So when he mentioned that it's income in addition to dividends, the option premium is completely separate stream of income in addition to the dividends that are being earned. But we do time our purchases around these ex-dividend dates to enhance yield where possible. So we buy the stock when we believe it's in the target range, buying CNR at 150, and we immediately do the covered call. We reduce our cost instantly because we don't know where CNR will go. It can go higher, it can go lower. Currently, in the last few days, it's gone below 150. So we bought it and it's gone down. But because we do options and we sell call options, we're constantly collecting this stream of income. So we're not concerned if the stock goes down because we know that as we own a company which is blue chip, is a top name, we're comfortable with owning that exposure long term and we can continue to chip on our cost while we have that.
Till we hold the stock in perpetuity, we can go on chipping on the price.
So we're able to generate the income as well as reduce the risk on the individual holding. This is one of the real trades we did last week. So we bought CNR because it came into our buying range of $150 per share. And this was on September 6th at 11:36 a.m. We don't do this on an individual basis. We do this in block trades. So we'll buy 1,000 shares, 5,000 shares, 10,000 shares, all in lots of 1,000. And then we allocate to individual clients. So some clients who have exposure to CNR, we might not buy more exposure. But there are other clients who may not have exposure to CNR, so we may decide to buy some for them. But it's all client specific in terms of their risk tolerance. And if they want to be invested as heavily in the market, that's the only time where we would allocate to them. But we buy everything in block, so we bought CNR at $150 per share, and we immediately sold the call option, giving a counterparty the right to take the shares from us at $155 till December. And for that right, they paid us $3.50 per share today. Effectively, our cost goes from the $150 purchase price minus $350 to $146.50 per share. But remember, we have an obligation till December. So someone can call for those shares at 155 level. And they'll only do that if the stock is at 155 or higher. But we don't know what happens in the markets over the course of the next 3.5 months. The stock can go up, it can go down, it can go sideways, which leads us to the next slide. Same as the real estate situation. If the stock goes up, everyone's happy because for us, we're making money. If the stock, even if it goes to 155, we're exiting at 155. If it goes to 160, we're obligated to sell at 155, but we're still making money. The other two situations are the ones which we want to protect because the stock can go down. In fact, it has gone down currently, but it can change. Next week it can be at 150 again, it can be at 155, it can be at 144. We don't know. If the stock goes down, we start making money in the option market, because when we're selling options, we're selling time and collecting money. As time elapses, the value of the money which we collect today, a month later, will continue to go down. It will start to decay. So we can go back to, let's say, November, and let's say the stock is still trading around $145 per share. That right is no longer as valuable because so much time has passed. So we might be able to go into the market and say, buy back that option at 50 cents to free ourselves from that right. So after selling something for $3.50 and collecting 50 cents and paying out 50 cents, our net profit on that option is $3. So we bought something at $150, reduced the cost net by $3. We're no longer in an obligation, so our cost is permanently reduced to $147, and we can sell another option in the context of the market. So if the stock is still trading around the levels right now, instead of doing the next set of options at 155, we may do 150 March, just because we want to continue to chip on the exposures that we have at this time. So in this package that we've given everyone, the fourth last page, if you can turn to that one. Sorry. Can you just to the next page? Yeah. Can you show us what
This is that alert page, this one?
Yeah. So
Last.
I know it's a lot of lines, but essentially it shows different stocks, different ETFs, different indices. If we see the one at the bottom, you'll see Walmart. Walmart, we had bought the shares in February 2021 at $136.99 per share. And through all the options that we did during that period of time, we've reduced the cost to $110.19, and that's just option premium. The dividends are separate because we're shareholders. So what we do is we buy the blue chip stock when it's in our range, in our target buying range, and we continuously chip on the cost till we, as much as we can, till it's zero or even negative, till we're basically fully profitable on our investments and we're playing in the market for free. And that happens over time. We've been there, we've done that for many stocks, but unfortunately that only happens to stocks which are a little bit more volatile. You won't see it as much in some of the stocks which are not as volatile. So any utilities or any of the banks or some of the Canadian securities. So we need to have the markets where they have good liquidity in the options and good premium. So that page shows some real examples that we have in the system. And yep. Sorry, can I get the remote back? Remote. Sorry. So the mechanics overall is if CNR is called away by December, we make $8.50 per share. And if it's called away at 155 minus 147, that's $8.50, sorry. 155 minus 146.50, 850 on an investment of 146.50, which works out to 5.8%, and we also have downside protection from the option. And this is in the Canadian market, even though if we were to do some of the stocks in the US, even CNR is listed in the US market as CNI ticker, the premium is a little bit higher, just given the fact that there's more liquidity. But this is one of the good names, that's why we're trading CNR in Canada, because it's a good company, pays a healthy yield on the dividend side, and it also is optionable here. So. Now, the most important thing with options is they are taxed as capital gain income. So any income that you're collecting, unlike real estate, if you collect income from real estate, you're paying tax based on your marginal tax rate. So it's taxed inefficiently compared to options, which are treated as capital gain income when you're reporting taxes.
You are paying tax only on half of that income, capital gains.
So in our case, we structure client portfolios depending on their risk tolerance, their individual preferences. A customized portfolio is built for every individual household. So some clients are a little bit more aggressive, some clients are very conservative, but we build the portfolio with top names and we start collecting rent on these individual stocks, in addition to the dividend yield that you can get.
Yeah.
And we don't charge individual fees for individual trades. So we have access to unlimited trading in our platform for a fixed fee based on assets under management that you have. Because we need unlimited trades. We're very active traders. We're trading daily. So it's difficult for us to charge transaction fees. It doesn't make sense to do that. So we need unlimited trades. You want to cover taxes?
Okay. So what else the covered call do rather effectively? One is help in managing taxes, year-end tax balancing. Every year, around 15th of November, we send a note to all our clients, whether they are dealing only with us or they are dealing with 5 different banks. Say, okay, look at your tax return. I used to have tax practice from 1990 to 2000, so I have slightly better idea about taxes. So we send a note to everyone around 15 November saying that look at your line 12700, which is taxable capital gain from your tax return for the last 3 years, and 25300 net capital losses from the other years. Look at that and look at if there is any blur. We want to ensure if you paid taxes on capital gains 3 years ago, you can recover the money from the government, right? You can go back only 3 years, right? So we say, okay, give us the figures, so we will do the balancing for you for taxes, and what we do is we start working with the options, because options you have immense possibilities. Generally you will find at the end of the year all these financial publications, they will say, okay, you want to create gain, Royal Bank is up, you sell Royal Bank buy TD, or you buy this ETF, sell that one, right? Nobody in this country talks about options. Options are such a versatile tool. You can move series, you can move from November to December, November to January, November to back to October, anything at all you want to do, and move from series 160 to 150, 160 to 150, anything at all. So what we do is we balance taxes for everyone. First we balance for this year's taxes, right? Capital loss we balance out, and then we go back to previous years to recover any money that they have paid on taxable capital gains 3 years earlier, because you cannot go beyond 3 years. So first we will tackle, for example, in 2023, when they can go back to 2022, 21 and 20. So first we will tackle 20, so that money is not completely lost, right? This we do for everyone. The second one, partly protecting the embedded gains, book gains in stocks, obviating the need to sell. The simple situation is, let's say you bought Royal Bank some 15 years ago or 20 years ago, and you bought at say $70, and then they split and split and split, and currently when you look at your statement, investment statement, it shows the book value at $5 or $10, right? And the actual price in the marketplace is around 120, right? 118 or so.
120.
All the Canadian banks are taking a hit at this stage. Yes. But you know what? You have huge book gain in a taxable account. You don't want to sell, because if you sell, you have to pay taxes immediately, right? But if you are using this strategy, if you are continuously collecting income in addition to dividend by selling covered call, you never need to sell the whole life. Leave it there, right? That is the second one. Then, so it allows you, eventually you have to pay, because Revenue Canada is they are the only people who will chase you even if you are gone, right? So, then third is help in managing the two human emotions of fear and greed much better. And that is, fear is, my stock is going down, it has gone down so much, I bought NVIDIA, it has gone down, Tesla, anything at all, right? So if you are continuously collecting income out of that, the fear factor has gone down. Greed is, oh my goodness, I bought this stock, I bought Apple, it is taken away at 180. Now it is 198. Actually now it is down 176 or so. It went up to 198. And you are thinking, oh my goodness, I did the option, so my stock is called away at 180. Who cares? Question is, you made money which you had set up initially, and then you have cash. Cash is king. Invest elsewhere. When Apple comes back, buy Apple. Who cares? Nothing moves in one direction, right? So the two human emotions of fear and greed, unless you are a Warren Buffett, where there is no fear, and because he says he buys businesses and he sits on them for ages, and we follow him very closely. He has right now put on Occidental Petroleum. Whenever it is below 60, below 60, you buy it in a big way, right? So what else is covered call doing despite now? Resounding endorsement by Wall Street and so many other journals. Our research is all independent. We read everything. We read from Royal Bank, we read from CIBC, TD, everything. But then we focus more on Barron's, focus more on Market Watch, Wall Street Journal. So despite resounding endorsement, why people are not doing this? It is such a simple thing. First is lack of knowledge. Options are too risky. And the problem is, here. I have something here. It is the third. It is fifth page, introduction. This guy, this is one of the top writers. He says why people are not doing that, because they understand that most of the time when you buy options, they expire worthless. Time is running against you. So 75 to 80% of the options expire worthless. Why people are not selling options, collecting that money, knowing that the counterparty, they are losing money? Why don't they do that? It is simply because the lack of knowledge. Lack of knowledge, not only lack of knowledge, the most important thing is, the answer is the old trading axiom: fear and greed, fear of risk, fear of the unknown, and most important, fear of that which is not understood. Most brokers or investor advisors, when asked about the strategy of options selling, not buying, will give a response such as, you want to stay away from that is too risky. It is not risky. You are selling time, that's all you are doing. It is not risky, right? So
this one in your pocket, yeah.
Somehow, they create that impression, and that is bad. Now, and then it is difficult to execute unless you are in the markets. You are always pitted against professionals in a very thin or illiquid market. In our case, we try to overcome this by block trading. Practically everything that we do is in blocks. Now, when we are setting up the portfolio first time, of course, one brick at a time, right? But subsequently, everything is in a block for everyone. Then very few professionals or investor advisors grasp it or are ready to spend the time and effort in watching the market this closely and trading at the appropriate time. Also, the advisor has to be option licensed. Option licensing is not difficult, but they have to have the buy-in. And buy-in, I'll give you one simple example. In 2013, as one of the three experts asked by or instructed by Montreal Exchange to talk to the investment advisors and portfolio managers, about 70 of them, right? So I made an open offer there. I said, well, I cannot, you come to my office for the whole day, you sit with me, I'll also give you coffee, lunch, everything, and you understand the process. Why I am doing that? Because I want more liquidity in the marketplace, in the Canadian market especially, right? So I want to teach them so that they get involved. And we tell them, how we are structuring the whole thing, how we are using Pareto principle, top 25 security cover 75% of my book, that type of thing, right? You know what? Not a single person came. And I, again on this forum, it is being recorded, I again offer the same thing. Tell your investment advisors, go and talk to these people. There is no obligation at all. They are not our competition. We want to bring more liquidity in the marketplace. Then strategy may sometimes curtail upside. For example, Apple goes to 190 and you say, oh my goodness, I lost Apple at 180. Now beyond covered call, some other option strategy. You want to?
Absolutely, yeah. Yes. So again, we use options as defensive tools, and we almost are always selling options. The only time that we would buy a call option would be in the case of a caller example, which I'll get to in a second. We use put option strategy in portfolios only in non-registered investments, because currently the government has restricted and regulators have restricted the use of put options when selling in the registered accounts, whether it's RRSP, TFSA, but it can be done in any taxable account, corporate or personal. But essentially, when you're dealing with put options, it's like insurance. You're buying insurance, for example, an insurance company, when you have an auto insurance policy, the only time a payout is triggered is if a claim is raised. But if there's no accident or if there's no issue, that premium which is paid, the insurance company earns it. So we hope that that premium essentially that we're paying is for our protection and our peace of mind, whereas the insurance company is also hoping the same. But the only time the insurance company would lose on that bet is if there is an accident and all of a sudden they have a payout that needs to be made or a claim that needs to be paid out. The same thing we're able to do with stocks. So if we find that there are certain stocks and we're selling put options, we're essentially saying we're prepared to buy this stock if it were to crash at a certain level.
Put option, let us talk about selling afterwards.
Yeah, go for it. Yeah.
Put option, no? Sorry.
Yeah.
Put option buying, that is buying, and then we'll talk about
Sure, so that's the buying insurance. The collar strategy is when we're limiting the upside by selling a covered call, and we have a put which we have purchased as well, so that in case a stock were to fall below a certain level, we are allowed to sell that stock at that level. But insurance can be very expensive in Canada, especially in the US. If you're buying insurance for 3 to 6 months, it can almost cost you 6%, and that can eat into portfolio returns over time as well. So if we find that the markets are overbought or if they're very expensive and we want to go and buy insurance, it can eat into the portfolio return. So one mitigation technique is what we do is we'll buy a long-term put option, so we have the ability to offload the position at a certain target. Let's say Occidental Petroleum, we have Warren Buffett where he's prepared to sell the shares at $60. We buy the insurance and immediately we sell short-term calls against that. So we do covered calls to finance the insurance policy that we have purchased. But that strategy is, again, for someone who's very concerned about the markets and they want to minimize the impact both to the upside as well as the downside. They don't want to see major fluctuation in the portfolio, but they're prepared to sacrifice either or. But insurance is always coming at a cost. But as we mentioned, we mostly sell insurance. So if we find that Apple, for example, Apple just last week, we decided we'll sell out of a good portion of our position because we had good profits. So we didn't wait till the expiry of our covered calls. Instead, we decided to reduce the position by half because when they go into these new products from a seasonality perspective, they tend to open a little bit lower for those few weeks. So we decided to take that position and we decided to sell out of them. And immediately we sold put options to buy the same stock 10 to 15% cheaper. So after selling very high, we set up a wheel strategy where we sold high and you're able to buy the same stock or same security low. So the only time we do a put option where we're selling an option or we're selling a put option or we're selling insurance is when we believe that these are stocks which we want to buy at a discounted level. And this is one of the trades that we had done for the same stock, CNR. We're not comfortable, let's say, with paying more than $145 per share. So what we decided to do is we sold someone the right to give us the shares at $145 per share till December. And for that right, they gave us $3.40 today. So we're the insurance company. We've collected $3.40 premium, and we're insuring the stock at $145. If it falls to $145 or lower, we're obligated to purchase it.
And Ankit, this is exactly at the same time when we did the call option. Yes. So simultaneously we did put option for some of the clients to buy it cheaper.
Exactly. Some of the clients who had the CNR in their portfolio, we sold it at a profit and decided we'd set up something to be bought a lot cheaper. Now in this strategy specifically, we need to keep cash in the portfolio, and the cash can be kept in a short-term GIC or any money market alternative, so it's also earning interest income while we're waiting, and fortunately the yields are very high at this stage, so we're able to generate good interest income while we're waiting for this position. But the cash needs to be in the account. That's why we do cash covered puts. We don't do naked puts. We have to have cash ready in the account to meet these obligations when they're due. But effectively, the $3.40 that we collected per share, we're pocketing $340 on an investment of $14,500, which is 2.34% in 3.5 months. And we don't annualize because if we annualize, we don't know what happens in the other 8.5 months. But for that period of time, we're getting 2.34% return plus the interest income that's being generated on the cash which is invested in the money market. And again, we do this mostly in cases where stocks have moved high and we want to take the profits and we want to be able to buy that same stock or ETF or index at a lower level. If the stock does remain above December 145, then we've collected all that premium, there's been no payout. I mean, that's when we win. We're able to collect that income, we have cash free again to do the next deal. And just like call options, put option premium is completely tax deductible and it's taxed as, it's taxed as capital gains income.
Can I take that one? Yeah, okay. So, security selection, the most important, key takeaways, most important thing is security selection and diversification are vital. Default theory is simply, there was something in 2000, I don't know how many people had gone through that dot-com crash. In 2000, including Northern Telecom, which was our number one company in Canada, beating Royal Bank and everyone else, they went to zero, right? So dot-com era, there was an article in Wall Street in 2001, early 2001, saying that default theory is simply your stock, technology stock goes from 100 to 10, right? And next year it recovers to 100%. But from 100 to 10, from 10 it has gone only to 20. But in default you can never recover. It will, you will always be stuck there. So the only thing is, if it is taxable account, you write it off, or against other income and all. But default, we avoid that. One of the ways to avoid that, first of all, security selection is very important, which we learned in 23 years. We are sitting on some of the things like Disney, for example. All is a big holding for us, and we are thinking, what is happening there, right? But we are still holding on, right? But you will always, if you listen to people like Peter Lynch, he will say, if you have 7 out of 10 correct, you are still laughing, right? So we always have 1 or 2 which backfire, but still it works because we are continuously collecting the remaining one on those 2. Second, in addition to stocks, we extensively on indices, Dow Jones, S&P, QQQ. Currently, we are not doing a whole lot on XIU because the option premiums are not so good. But with the involvement of all of you, when you go to your investor advisors, portfolio manager, say start doing this, there will be more liquidity. It will, as I said, open offer. If they want to come and sit with us to understand the process, we are more than happy to do that for them, right? So in Canadian market, due to less liquidity and high bid-ask spread, our trading is mostly in weekly options that offer better risk reward opportunities at this stage. And MoneyShow Exchange is actively educating portfolio managers and investor option strategies, and actually they are taking many initiatives. Like I think in 2013 they came to Ankit. We were attending one of their annual option education day, and they came to Ankit. They said, "Oh, you are still at school?" He said, I'm at Schulich School of Business. You don't look like you are in a business school, but do one thing. Why don't you become brand ambassador for Montreal Exchange, and tell all these people, BBA students, MBA students, the people who are doing doctorate, we have scholarship for them. So they are using different avenues. They did it not only for Schulich, all the Western and all these universities. They did it very effectively, but somehow it is not catching up the way we would like it to. These are some of the reference books, and the first one we are referring. Essentially, I think we have 4 or 5 copies. We'll give them away. We'll also give away some more books, right? So these are some of the books that we have. Now, this Bible of Option Strategy. This comes from London, England, where I first learned options a long time back, 1982. This is really a Bible. This has, I think, around 56 different strategies, complete dissection, what is involved, how do you execute in the strategy, what is the risk involved, how do you mitigate, everything is there, right? But I tell people, if you want to start working on your PhD, start with this, right? But ideally, you have to learn 3 or 4 strategies, be master on, be second to none on them. In that case, you are lucky. You don't have to. So in our practice, we are mostly covered call writing. We are doing selling cash covered put. We are doing callers, right? We are doing some spreads, not a whole lot, but we are doing spreads also. But we don't get into butterfly and all these things. We can discuss with you, any one of you, if you are interested. But in the practice, we don't want you, right? So that is my request to everyone. This is something about what we do, right? That is also in your package. And question and answer we are not taking today just because we are running out of time. But my request is any questions that you have, any one of you, we are here till about, I think beyond 4:30. 4:30 is the closing, unless they allow us, right? Any number of questions you have on options, kindly come to our booth 311. We'll be able to address them. Right? So,
thank you.
Thank you.
Yes.
Michael, thanks. Great job.
Thank you so much.
Thank you.